If you've spent decades building your retirement savings, the last thing you want is to hand over tens of thousands or even hundreds of thousands of dollars to the IRS that you didn't have to pay. Yet every single day, I see retirees make the same three costly tax mistakes that drain their accounts and limit their retirement lifestyle. I'm PJ Gibbs, a certified financial planner, and I help people within 10 years of retirement make confident income, tax, and investment decisions so they can retire without guessing. Today, I'm going to walk you through the three biggest tax mistakes that cost retirees a fortune. And more importantly, I'm going to show you exactly how to avoid them. Now, these aren't complex strategies that require a law degree. They're straightforward planning moves that, if you get them right in your 50s and 60s, can save you six figures over your lifetime. Mistake number one: taking Social Security at the wrong time and creating a tax bomb. Let's start with what might be the most expensive mistake retirees make: claiming Social Security without considering the tax consequences. Now, most people think about Social Security in terms of how much they'll receive each month, but they completely miss how those benefits interact with their other retirement income to create what tax planners call the Social Security tax torpedo. Here's how this works. When you combine your adjusted gross income plus any tax-exempt interest plus half of your Social Security benefits, you get what's called your combined income. If you're married, filing jointly, and that combined income exceeds $32,000, up to 50% of your Social Security becomes taxable. Push above $44,000 and suddenly up to 85% of your benefits are now taxable. Let's go through a real-world example. Let's say you're a married couple who retires at 62 and immediately starts taking $50,000 per year in Social Security benefits. You also need to withdraw $80,000 from your traditional IRA to cover your living expenses. That IRA withdrawal is fully taxable, which means your adjusted gross income is already $80,000. Now, add in half of your Social Security, $25,000, and your combined income is $105,000. At that level of combined income, you're going to pay federal taxes on 85% of your Social Security benefits. That's $42,500 of additional taxable income on top of the $80,000 IRA withdrawal. Your total taxable income is now $122,500, which pushes you into the 22% federal tax bracket for 2026. But here's where it gets painful. Because of how Social Security taxation works, your effective marginal tax rate in certain income ranges isn't 22%. It's actually 40.7% because of the tax torpedo effect. Over a 30-year retirement, this single mistake of not coordinating your Social Security claiming strategy with your other income sources can cost you well over $100,000 in taxes. So what's the solution? If you have substantial retirement savings in traditional IRAs or 401ks, you might actually want to delay Social Security until age 70 while you strategically draw down those pre-tax accounts and do Roth conversions during your early retirement years while your income is lower. This keeps you out of the tax torpedo zone later when you do start Social Security. Alternatively, if you claim Social Security early at 62, you need to be extremely careful about how much additional income you're generating from other sources. This brings me to the second massive mistake: completely missing the golden opportunity to do Roth conversions between ages 60 and 72. This is one of the most powerful tax strategies available to retirees, yet hardly anyone takes advantage of it. Here's why this window is so valuable. Let's say you retire at 62. You're no longer earning a paycheck, so your income drops significantly. You haven't started Social Security yet, and you're not required to take distributions from your IRA until age 73. This creates a beautiful window of opportunity where you're likely in your lowest tax bracket that you'll ever be in during retirement. For 2026, if you're married filing jointly, the 12% federal tax bracket extends all the way up to $100,800 of taxable income. After taking the standard deduction of $32,200, that means you could have gross income of $133,000 and still be in just the 12% bracket. This is your chance to convert portions of your traditional IRA to a Roth IRA and pay taxes at historically low rates. Why does this matter so much? Because every dollar you convert to a Roth grows tax-free forever. You'll never pay taxes on that money again, and it won't count towards your combined income for Social Security taxation. Even better, Roth IRAs have no required minimum distributions during your lifetime. so you're not forced to take money out and create taxable income later. Let's go through another example. Imagine you have $800,000 in a traditional IRA at age 62. If you do nothing and wait until age 73 to start taking required minimum distributions, you'll be forced to withdraw about $30,000 in your first year. And those withdrawals will only increase as you age. By the time you're 80, you could be taking out over $50,000 per year, all fully taxable. But what if instead, during those years from 62 to 72, you converted $50,000 per year from your traditional IRA to a Roth? You'd pay about $6,000 per year in federal taxes at the 12% rate, assuming you're filling up that bracket strategically. Over that 10-year period, you'd convert $500,000 and pay roughly $60,000 in taxes. Here's the payoff. That $500,000 grows tax-free. Assuming a conservative 6% annual return, by the time you're 80, that Roth IRA could be worth over $900,000, and you'll never pay another dime in taxes on it. Compare that to leaving it in the traditional IRA, where at age 80, you'd be pulling out $50,000 per year in fully taxable income, potentially paying 22% or even 24% federal taxes on those distributions. Over your lifetime, the difference could easily be $200,000 or more in tax savings. The key is to do this strategically. You don't want to convert so much that you push yourself into a higher bracket unnecessarily. And you definitely don't want to convert everything at once and create a massive tax bill. This is where working with a certified financial planner who understands tax planning becomes invaluable. The third big mistake is one that catches almost everyone by surprise: not paying attention to the order in which you withdraw your money from your accounts. This mistake can trigger something called IRMA, the income-related monthly adjustment amount, which dramatically increases your Medicare premiums. Here's how IRMA works. Your Medicare Part B and Part D premiums are based on your modified adjusted gross income from 2 years prior. So your 2026 Medicare premiums are determined by your 2024 income. For 2026, if you're married filing jointly and your income exceeds $218,000, you'll start paying IRMA surcharges. The standard Medicare Part B premium for 2026 is $202.90 per month. But if your income is between $218,001 and $274,000, you'll pay $284.10 per month. That's an extra $81.20 per month, or $974.40 per year per person. For a married couple both on Medicare, that's nearly $2,000 per year in additional premiums. And it gets worse as your income increases. At the highest income tier, you could be paying $649.20 per month for Part B, more than triple the standard premium. Here's where withdrawal order becomes critical. Let's say you're 66 years old and you need $100,000 to cover your living expenses this year. If you withdraw that entire $100,000 from your traditional IRA, it's all counted as taxable income, potentially pushing you over that $218,000 IRMA threshold when you combine it with other income sources. But what if you used a smarter withdrawal strategy? Instead of taking everything from your IRA, you could first withdraw from your taxable brokerage account. If you've held investments for more than a year, you'll pay long-term capital gains rates, which for 2026 are 0% on taxable income up to $100,800 for married couples, and 15% on income between $100,800 to $211,400. That's significantly better than ordinary income rates, and it generates less taxable income than an IRA withdrawal. Second, if you have a Roth IRA, those withdrawals are completely tax-free and don't count towards your modified adjusted gross income at all. They won't affect your Medicare premiums or cause more of your Social Security to be taxed. Third, only after you've tapped those more tax-efficient sources should you withdraw from traditional IRAs or 401ks. And even then, only up to the point where you stay below critical thresholds like the IRMA cutoffs. By being strategic about withdrawal order, you can often reduce your taxable income by $30,000 to $50,000 per year, which keeps you below IRMA thresholds and out of higher tax brackets. Over a 20-year retirement, avoiding just one or two IRMA tiers can save you $30,000 to $50,000 in Medicare premiums alone. Now, here's what makes these three mistakes so devastating. They compound on each other. When you claim Social Security at the wrong time, you increase your taxable income. That higher income might push you into IRMA territory, costing you thousands in Medicare premiums. Meanwhile, because you didn't do Roth conversions during your golden window years, you're stuck with a massive traditional IRA that's about to explode with required minimum distributions at age 73. When those RMDs start, they create even more taxable income, which causes even more of your Social Security to be taxed at 85%, which pushes you into even higher earnings bracket. It becomes a vicious cycle that can drain hundreds of thousands of dollars from your retirement accounts over your lifetime. I've seen this exact scenario play out dozens of times. A couple comes to me in their mid-70s, frustrated that they're paying $40,000 or $50,000 per year in federal taxes alone, not to mention state taxes and elevated Medicare premiums. When we look at their situation, it's almost always because they made these three mistakes early in retirement, and now they're locked into a high-tax situation for the rest of their lives. The tragedy is that it didn't have to be this way. With proper planning in their 50s and 60s, they could have cut their tax bill by $200,000 or more. So what should you do if you're approaching retirement or already retired? First, if you're within 10 years of retirement, let's model out different Social Security claiming strategies. Don't just assume that delaying until 70 is always best, or that claiming at 62 is always wrong. Run the numbers based on your specific situation, including your other income sources and your tax bracket. Second, as soon as you stop working, start looking at Roth conversion opportunities. Every year between retirement and age 73 is potentially valuable. Work with a financial advisor or use tax planning software to figure out how much you can convert each year while staying in the 12 or 22% bracket, rather than waiting until RMDs force you into the 24 or even the 32% bracket. Third, create a written withdrawal strategy that prioritizes tax efficiency. Know which accounts you'll tap first, second, and third. Build in flexibility to adjust based on market conditions and tax law changes. And always keep an eye on those IRMA thresholds. The bottom line is this: retirement tax planning isn't something you do once and then forget about it. It requires ongoing attention and strategic adjustments, but the payoff is enormous. Getting this right can literally be worth six figures over your lifetime. If you're in your 50s or early 60s and you want to make sure you're not making these costly mistakes, I can help. At Trello Wealth, I help families and retirees simplify financial complexity with personalized planning and disciplined investment management so they can move into retirement with clarity, confidence, and peace of mind. Visit the link in the description to complete our retirement readiness scorecard, or schedule a call with me. We'll walk through your specific situation and show you exactly where you might be leaving money on the table, because the best time to fix these mistakes is before they cost you hundreds of thousands of dollars.